And we are live. Good morning to everyone on Behind the Markets on this gracious Thursday, the 23rd of March. You know, Vernon, the first 3 months of the year basically determine how your year will end. So if
Uh-huh.
you are not in motion, people, where are you not in motion in your life? This is your last chance before you start climbing an uphill battle. Does that mean you cannot make your goals for the end of the year and just have to surrender to your needs? No, it doesn't. But you are starting your year in the negative if you have not used these 3 months to get going. That's why you're supposed to go into the year in full momentum and then keep going. But you use these 3 months. If you didn't manage to do your planning and get yourself steady these 3 months. So Vernon, the question we all need to ask is, are we on track? Are we on track for having a
Yeah.
good start, or are we waiting? Are we waiting for a miracle, an intervention, a change? That is the question to everyone there. I throw that to you, my brother. How are you doing?
I am doing very well. I think I've been remember the other day I was telling you that I'm just ecstatic about a few things here and there. And as almost concluding the month of March, of course, is an indicator of having to speed up a few things here and there. And I've been having sleepless nights literally for the last 3 days.
Yay, hey, hey. So at least that means you're catching up. You know, at least you got either if you're sleepless but sober, it means you've got work to do, or you're just worried
Absolutely.
about everything. But if you're sleepless but drunk, we have to talk. That's where that's where the issues are coming. Anyway, but let's kick off into today. We're gonna go through our usual run of the market roundup, and then we're gonna get into the deep dives for the day. Then we're gonna touch into our chart of the day before we get into our deep talk, where we're gonna talk about entrepreneurship. The questions, Vernon, about the transition between employment and entrepreneurship. People really struggle with this one. It's a real deep conversation because some people try and engage in it on the side, while some people try and go into it. How do I go through where I'm going into entrepreneurship full time? How does that transition work? As a person who has abruptly done that transition before, I will talk you through it. I will talk you through it, my people.
Yeah.
Uh, because it's a tough one. It's a doozy. I've seen a lot
It
of people
is.
struggle through it. I struggled through it myself, and I'll tell you my story about what you should actually be doing, or what I suggest. Let me not say what you should, because you get touchy about being told what to do. But what I suggest might be your move if you're trying to make that transition between employment and entrepreneurship. And I will talk also, Vernon, about our final quote today. But today it is Financial Literacy Week. We're talking about wealth creation, people. We're talking about wealth, but we're also talking about career capital, because it is about trying to make sure that your career develops the capital that allows you to develop financial capital. Remember what I said at the beginning of the week, Vernon. It is your knowledge capital that becomes your career capital, which
Yeah.
then becomes your financial capital. It's what you know that determines what you can do. What you can do determines how much you can get paid. How much you can get paid determines how much you can invest. And from right there, we're there. So it really starts with knowledge acquisition converted into action. I was reading a book called The 5 a.m. Club. And in the first chapter, I'm still in the early parts of it, and it says there's a quote that says action without in fact, let me get it word for word, but it is Robin Sharma's book, where he talks about morning rituals. And when you say morning rituals, people will start thinking you're talking about voodoo. But he says ideas are nothing unless backed by application. The smallest of implementation is worth more than the grandest of intentions. Okay, that is what everyone has to understand. Whatever you know must be converted into an application, then you can transfer. So let's get down into the market roundup first. Today, Vernon, we are still on the rundown, the electric slide of the Kwacha, down 116 days of consecutive loss of our currency against the US dollar. For the last 116 days, there has not been a day where the Kwacha has ended stronger. The Kwacha has ended consecutively weaker for 116 days, the second longest streak on record, second to the longest streak, which ended in 2021, which was 201 days. Okay, that's when the Kwacha now started touching into the 22 zone. So we're currently at 20.9255 on the interbank rate, up 0.52% as of yesterday. One of the highest jumps we've seen. the dollar is up 15.63%. So as a defensive asset, it's doing pretty well. On the month, it's up 7. This has actually been one of the strongest months of the dollar run. Half of the gains of the dollar for this year have happened in just the last 30 days. So we've had a rapid devaluation. So even with the Bank of Zambia stepping in to curtail, to squeeze the reserve ratio, even with them raising the interest rates, still, in fact, it even made it worse, because I think it confirmed to the market the worries of what's actually been going on. Yesterday, we did see the Rand move up by 1.32%, up 6.52% year to date. It's kind of wobbling along the axis, but we are starting to get a lot of Rand strength picking up. The Rand is slowly edging up higher against the Kwacha, meaning the inflation cost of products coming in. That's going to be a problem for South Africa. So it might slow down some of their imports to us, some of their exports to us. But then again, it also might create inflation for us on that side of things. Taking a look at the bond market, we have seen that bonds did move up by 0.1% on the secondary market. Remember that we have got an auction coming in next week. You have 7 days until the final bond auction of the quarter. Remember, it is going to close up on the Thursday of next week. That's when you're going to get the bond auction. Unfortunately, BOZ has not yet released the letter. We are still waiting for it so that we can give you our recommendations. That's what I always do with people. I always give them what my expectations of bond prices are, but yields are probably going to stay the same. It's probably going to be fresh issues, because it does seem that every 3 months they're issuing a fresh bond, especially for the benchmark ones of 3-year, 5-year, and 10-year. So expect new ones, and therefore we'll probably just have to revert to the old prices. Interest rates going up. We just saw the 2-year was the last one in the last bond auction that went up, but we are seeing interest rates starting to slide back downwards slightly to 24.59. But the bond index is up 4.96% year to date, while we're also seeing that the US dollar version of the bond is down 9.23% because of the loss of the Kwacha and also the bond sell-off that happened last week. So we are kind of in that reversion. So bonds are kind of just tracking inflation at the moment. They are just keeping up with inflation, except for the losses that happened last week. So bonds, I think, have started the quarter probably just slightly below inflation, but they probably will continue to pick up, as we do expect inflation might start slowing down, mainly because of the weakness of the oil price, which is starting to recover, by the way, the global oil price, and also the interventions. Remember this, if you do get diesel coming into Zambia cheaper, it also does mean that the trucks that drive diesel, the trucks that drive petrol into Zambia, which use diesel, will probably have a lower cost attached to them. So that's kind of the efficiency of trying to get diesel prices down. Because remember, because you're transporting petrol by truck, you're also then using lower transportation costs because of lower diesel costs attached to it. So that's, I think, the big battle for all of us here, trying to get the diesel prices down. Then seeing, I know that some economists have actually suggested, which I do agree with, maybe trying to transfer some of those savings, maybe pushing down the diesel price by about reflecting about 70% into the diesel price, any savings there, but then transferring some of that into either the development of a pipeline or the subsidizing of petrol. That could be something to try and cushion inflation. So we are seeing lower prices of oil while we've got restructuring on the way. So these two things should actually help as we wait for 2026, when we start to get in oil from Angola, because that's going to be the long-term intervention, getting oil from Angola. Though I have always talked about the fact that people need to start thinking about the electric transition. It's not a good idea, Vernon, to run your transportation system on an energy source you don't have control over, because it's always going to be exogenous factors coming in. But it's a tough thing. I mean, we only have 900,000 cars in Zambia, one car for every 10 adults in Zambia. That's how. In fact, even if you take it amongst the working population, the employed population of Zambia, it's still one car for every 3 employed people. That's how few cars are available in Zambia, because we still have a fleet of somewhere around 900,000 according to the last RATSA annual report. We're also seeing in terms of our commodity reach, we're seeing that copper went up 2.08%. We've had a copper rally, which recovered some of the gains from the losses we saw. Remember, copper took a huge dip when we started seeing that banking crisis but we started to see that wavering, and we started to see prices of copper started to come up. Even though there was a Federal Reserve rate hike yesterday, we still did see prices of copper up year to date 6.84%, up on the month, up on the week, sorry, up 4.98%, but down on the month 2.15%. Oil went up also by 1.94%, up to $75 on crude oil per barrel. In terms of the Brent price, up 1.55%, but year to date oil is still down 11.73%. The problem is the kwacha, the dollar is up 14%. That's where the problem is coming. You got a dollar that's up 15%, but oil that's down 11 year to date. That is what is causing the price upward movement. Now, in terms of gold, we saw gold also up 1.03% yesterday. So across the commodity spectrum, we did see all the prices up. Problem we saw yesterday, Vernon, was that those who are in the crypto craze got whacked yesterday. Ethereum down 4.6%. Trust me, I say those. Well, I am one of them. 4.6%. Ethereum was down 2.7%. Bitcoin got knocked down in terms versus the kwacha. It's still up 88.89% year to date, with Ethereum up 65.82%, and gold is up 24.84%. Now, I must break out into chorus one more time because I always feel I have to say this. People, cryptocurrencies and wealth insurance assets are often very risky and very volatile. Do not put all your money in there. It's advisable to only maybe put 5 to 15% of your money and keep your regular part of your investment portfolio in the stock market, bond market, and property market, things that are easily regulated and things that are easily managed, because these are the unregulated spaces of our financial system.
Absolutely.
All right. Now, looking obviously, so year to date in terms of all the assets that we are assessing, 4.96% in terms of bond upwards. Stocks up down 0.99% due to Standard Chartered, which had a sell-off yesterday again. And you saw USD. The USD is up 15.63%. Gold is up 24.84% year to date, while Bitcoin is up 88.89% and Ethereum is up 65.82%. As I say it again, people, just because you're seeing those rates of return, always be risk conscious. In fact, The Intelligent Investor by, I don't know if you've ever had a chance to get your hands on that book, but The Intelligent Investor, Benjamin Graham will always tell you, always be alive to risk. Be conscious of it and understand the implications of risk. Quickly, Vernon, as we touch into our four horsemen outlook, we did see yesterday that UK showed signs of rising CPIs. In other words, inflation for the consumer in the UK was rising, but for the producer, it was declining. So we're getting a bit of an industrial problem in the United Kingdom. On the other side of the spectrum, we are also seeing that German interest rates started going downwards. We did see a downwards movement in terms of German interest rates, along with U.S. mortgage rates. South African inflation rates also started rising. Remember, that will probably reflect. You've got a stronger rand, and you've got inflation happening in South Africa. That's imported inflation waiting to happen into Zambia. Crude inventories in America did rise, but the prices still did go up. And we did see yesterday that Brazil's government forecasts that they will have they will have a lower primary deficit, meaning that their currency will probably get stronger. And remember that you import about 50% of your imported beef comes from Brazil. Okay, so when you start getting a stronger Brazilian real, that means you got a more expensive beef that may be coming into the rest of your country. But the biggest news yesterday, Vernon, from the global economy was that the Federal Reserve did hike rates by 25 basis points, slowing down from the 50 basis points that they were hiking. So the Federal Reserve is slowing down, but Federal Reserve Chair Jerome Powell did say, I'm not cutting interest rates this year. He said it's not on the books to cut interest rates this year, but we are expecting that in 2024, you will start seeing interest rates start to slide downwards. And that is part of the major parts of the news. Those are part of the major parts of global news. Good morning to everybody who's joining us, whether it's Muguka, Priscilla, Precious, Wicks, and Rona. Thank you very much for joining us from all over the country. Okay, now touching up on most of our news. Now, also just quickly touching into the data that we're looking in for the economic calendar data that we saw in from yesterday, closing out the rest of yesterday. We did see that the new house price index in Canada was down, showing that new homes are coming in cheaper and cheaper, and therefore there is a little bit of a struggle there. We also did see that yesterday, after the US, we did see a rate decision from Brazil, which showed that interest rates are still 13.75% in terms of Brazilian policy rate. To control, they have been having an inflation fight. What we're expecting today is we're expecting the Swiss interest rate to be up by 50 basis points, one of the biggest rate hikes. We're expecting Switzerland may be starting to battle inflation. We're expecting no interest rate movements in Turkey, though inflation is out of the sky for them. We are expecting a 25% basis point hike in British interest rates, even though because their inflation is starting to rise. Jobless claims in America are expected to come in today to see if we have a tight labor market. Remember that the tighter the labor market, the more the Federal Reserve will continue to raise interest rates. Even though there is a banking crisis, it does show that the fiscal side is probably going to step in. Well, not really a full-blooded banking crisis, but a potential banking crisis. And that is our data read for today. But going into our deep dive, for today, touching into it. The first part of the deep dives that we're going to start is what we call the earnings seasons report. So for all of you who are stock market investors, you may want to pick up on some of the trends that we're seeing in terms of the fragilities of earnings season. Because listed company earnings, about 15 companies have reported their earnings, though we are still waiting on 2 more for this cycle, while the rest reported their earnings, their mid-cycle companies. But here are your earnings reports and your earnings reviews for 2022. As you can see, in terms of revenue growth, we are seeing that about there's been a 15% average revenue growth for the average listed company, and 66 or 2/3 of listed companies so far have cited revenue growth. We're still waiting on results from British American Tobacco and Zafico. But we did see one of the strongest with revenue growth from this term was Puma Energy, with revenue growth up 49.3%. Zambia Reinsurance with revenue growth up 47.2%. So these were the top 2, and then rounded up by Bata, whose revenue was up 36.3%. So you have seen relatively strong revenue growth across various parts of the spectrum. Profit growth, on the other hand, you did see the average profit growth was about 15.5%, with 3/4 of companies registering stronger profit growth. Strongest profit growth obviously coming from Zambia Reinsurance, up 363%. Puma Energy up 169%. Actually, the strongest was Bata, up 869%. In terms of revenue, in terms of profit growth. Now, going into the other parts of earnings growth, we did see that most companies did have positive cash positions, and they have continued to have positive cash positions. But cash growth was one that was a little bit dodgy. Only 50% of companies registered growth in their cash positions. So we are seeing a relatively strong rise in cash burn. That should be of concern, simply because the listed companies are probably some of the victims of higher financing costs and inflation. So these two things are leading to a relatively strong level of cash burn in the system. So pay attention to what impact that is starting to have on the system. Now, we're also seeing that operational cash flow did go up by an average of 37%. So on the operational side, businesses are actually seeing that they are cash flow positive operationally, while we are seeing that CapEx spending also is up on average 29%, with less than 60% of companies increasing their capital expenditures, while 75% of companies have increased their operational cash flow. So there has been problems, probably due to financing costs. That's probably what's been burning through cash for quite a lot of these companies, even though in the face of inflation, some of these companies have what we call pricing power. In terms of margin growth, you did see that gross margins have risen. 2/3 of companies who have shown their gross margins have shown that gross margins have risen, while operational margins are up for most companies, but only slightly, not too much, up 1.8% in terms of the growth of the margin. So we're not suffering with the inflation risk of margin compression. That's what we would have been worried about in strong inflation times, but not really what we call full-fledged. We're talking about energy price inflation. We would have been worried about margin compression. On the other hand, Vernon, about 58% of companies have given positive outlooks, and the average company, about 41% of companies, are what we call value stocks, are exhibiting signs of what we call value stocks. That means that their earnings per share is very good, their price to book value is very good. In other words, they're fair valued, they've got strong balance sheets, and they're paying a dividend. So only about six of the reporting companies, sorry, five of the companies that have reported have exhibited those claims already. But from the previous cycle, you can add about two more. So this is kind of your mix. This is what I call my earnings review. I would say, from my perspective here, Vernon, that earnings are looking relatively okay, but not stronger than last year. So we are seeing a steady earnings. 15% revenue growth is not rocketing growth. 15% profit growth is not rocketing growth, especially in the face of 10% inflation, okay, or 9.9% annual inflation. It means that really, on the real basis, we're not seeing much in terms of the growth. We're not seeing much that's way above. So the growth of these companies, probably what you're going to find is a lot of these companies are now fair valued. Okay, so they are finally fair valued more than anything else. So that is my deep dive into there. My second deep dive, but I don't know, Vernon, what your view is. Have you been keeping an eye on earnings season yourself?
Sorry.
Oh, so I was just throwing it out there. Have you been keeping an eye on earnings season? Or am I the only nerd who keeps an eye on these prices and these and this information? Anyway, it's my job. What can I say?
Well, yeah, you see, it depends. You're looking at it from a different angle, and there's always another aspect of where there's a production aspect, pricing of the product of the commodities that are being manufactured, and then there's the other earnings for the companies manufacturing and whatnot. And of course, last time, seeing how the financial sector and financial institutions have actually been doing quite well, it's different for them if you look at how their earnings and how people are actually
Mm.
benefiting from their products and packages. But yeah, I guess we've been following here and there, because in a way or two, it will still get to you. You go
Well,
into a
this is your
store.
stock market. These are your, more than it is as a retailer. This is your wealth. Remember that your
Mhm.
NAPSA is invested in here. Remember that your earnings from your listed companies in terms of your own pension, if you've got occupational pension, and these are your opportunities to invest. So just remember that we're on the cusp. My advice to as many people is, in this period of time, look out for dividend stocks and look out for value stocks. In other words, stocks where they are well priced. Okay, they are not highly overpriced. Use EPS and price to book value ratios to look at that. And then you also want to look at companies that have strong balance sheets and companies that have got growing profits and growing dividends, or at least are paying the dividends. So paying a dividend and growing profits, those are the symbols. You know who actually gave you that? Benjamin Graham. Those are Benjamin Graham's 7 principles of a value company. Benjamin Graham, as I pointed out last time, was the mentor of none other than Warren Buffett. So if you want to try and understand where that is, and Warren Buffett has built his whole investment philosophy. Biggest other news point on the deep dive, I'm going to read out a story for you, which I picked up yesterday on the news cycle. And I wrote, okay, the headline has been actually pointed out, but U.S. Treasury Department's proposed new EV tax credit guidelines might negatively affect Zambia, DRC, and Zimbabwe's EV battery production ambitions. Remember that Zimbabwe is trying to be the main producer of lithium. Zambia and Congo were even quoted by America saying, we're going to try and help you learn how to develop EV batteries. Well, the savior has come with a knife for our backs. So listen to what they've actually said here. So the new tax requirements, which the Treasury Department of America might be saying, are sourcing requirements for electric vehicle battery tax subsidies under President Biden's climate change law. So, in other words, you are allowed $7,500 of tax credits, which you can claim back against your taxes, which is about 10% the price of the EV. You can claim that against your taxes to encourage people. So, if you're buying an electric car, you've got up to $7,500 in tax credits, which you can use off to wipe off that Now, $7,500 of EV tax credits is only available to North American assembled electric vehicles that meet certain local battery production and mineral extraction standards. Wow, that's a jab at us. Okay, and they're saying that half of the EV's tax credit is contingent on at least 40% of the value of the critical minerals in the battery having been extracted or processed in the United States of America or in a country with US free trade agreements or recycled in North America. So, if the copper, the cobalt, the manganese, and the lithium were not extracted in America, if we don't hold an exact free trade agreement with America and it's not recycled in America, then the drivers of those EVs are disincentivized to buy those cars. Okay, because the tax credits are only for made in America batteries. Now, America's saying they want to try and get off China's hand because China produces 70% of batteries in the world. So they don't like being dependent on China. I understand that. Okay. But I wonder where this pulls us because they came to us saying we would like to try and help you improve your capacity. So you want to help us improve our capacity and then stab us in the back and say, however, we're going to disadvantage these. Because what this is going to end up doing is driving more of our trade to China. Okay. And more of our EV minerals will then go to China. The other half of the EV subsidies, another $7,500 subsidy, is contingent on the battery components being assembled in North America. So already you're saying, no, we're not going to accept. So any car, so let's say a battery is assembled between Zambia and DRC because we have intentions. And obviously with the lithium production that's coming from Zimbabwe, if we say Zambia, Zimbabwe, DRC were to come together and we were to start producing batteries across a wonderful supply chain, America would say, nice, well done, but they're not getting any tax credits. We prefer our batteries produced here. So you see, this is the talking out the side of our mouths I'm always worried about when it comes to US trade policy. Okay, on one hand, they'll always tell you, oh, we're here to help you. We want to see you benefit. Then on the other hand, they'll say, yeah, just give us the minerals. We don't want you to process them. We don't want those things processed here. So already, that's the main thing that you're seeing in terms of the US. My biggest concern on that deep dive is that we are playing into the US's hands if we're not careful. So today, Vernon, it being Entrepreneurship Thursday, and it is Financial Literacy Week, today I want to talk about entrepreneurship and wealth building. Now, here's the reason why I'm going to talk about it today. And I'm starting with our chart of the day to show it. But 66% of the US millionaires are self employed, and 80% of Dutch millionaires are self employed. And multiples also are self employed. You often find self employed professionals and entrepreneurs make up the large contingent of wealth and millionaires. So, one of the things that we should actually be paying attention to here is our chart for the day. And our chart for the day, first is this is labor force data. This is labor force statistics data, and it shows, Vernon, what the impact or what the size of entrepreneurship has been in Zambia over the last. So take a gander at this. This is the breakdown of who are the entrepreneurs in Zambia in thousands by age group and population. So we're looking at youth and we're looking at the above 35 population. So the number one entrepreneurship group as of 2017 and even as of now is still the men above the age of 35. Those are your biggest entrepreneurship group, mainly because they've got families to take care of. If they find themselves unemployed, they just have to start their business. And most of them have the experience to actually have built supply chains and to build an understanding. So these are entrepreneurs, and I'm counting people who employ. Okay, these are employers. Okay, because you're self-employed if you work by yourself. You're a business owner if you have employees. So I'm counting business owners and entrepreneurs. Okay, so we have seen that throughout 2018 and 2019, you could see there was a decline across all spectra, okay, across all groups. But then in 2020, there was a resurgence, and mainly because obviously there was huge unemployment levels. The pandemic started, people got online and said, you know what, might as well start my business. The pandemic actually, you can see, actually did lead to an entrepreneurship boom. As you can see there, 2020 and 2021, people went heavily into businesses and actually started hiring other people. So this is actually quite interesting. And the funny thing is that even in America, you're also seeing the same thing. Even in China, you're seeing the same thing. Europe, it appears that this pandemic made a lot of people who were sitting in jobs just say, you know what? I'm going to go out there and start my business. I'm tired of sitting on this one out. Life is short. Maybe people got scared by the fact that they thought life was short, c'est la vie, but they went into entrepreneurship. So you can see that the levels of entrepreneurship growth, especially after 2020, have exploded. We've gone from 54,000 men above 35 who are entrepreneurs to 93,000 men above 35 being entrepreneurs. We've gone from 21,000 men your age, Vernon, below 35. We've gone from that to 58,000. We've gone from 17,000 women above 35 being entrepreneurs to 33,000. So that number has almost doubled. And we've gone from 9,400 women above below the age of 35 being entrepreneurs to 26,000. So the fastest growing group is actually young women. They've tripled almost in numbers in terms of entrepreneurship. In terms of engaging in entrepreneurship and providing jobs for one another. But even as a group, women have gone from 26,000 or 27,000 as entrepreneurs all the way up as high as 59,000 women are actually engaging in entrepreneurship. So what's your take, Vernon, on these numbers of women in enterprise, or not even women in enterprise, just in terms of the trends that we've seen of people engaging in entrepreneurship?
I think, with the aspect of women feeling like, there isn't much of a space for them in the corporate world or in these male dominated spaces. So they have just but resorted to entrepreneurship because, I mean, no one is going to say nothing for you to, if you want to get into the entrepreneurship world. And if you go on the streets now, Soweto, Kulima Tower, City Market, Limbanda, half of those people are women and young people. So I
So those
feel
are the
they have found
self-employed, yeah.
absolutely. I feel they have found a place that they are really comfortable, despite you having, being male or female. They've actually resorted to that space because there is less discrimination, I guess. If you go to Soweto, most of the women carrying vegetables and sacks of vegetables and tomatoes are women. I feel there has been that significant, increase, with regards to female entrepreneurs growing, really because they found a space that is conducive, I think, and they're able to operate and maneuver as compared to one who needs a degree, maybe, who needs some sort of experience, and they don't have to worry about being in a space where it is male dominated. So long as I have my space and I have my produce or my product that I have to sell to people and people are able to buy, despite having sitting next to a gentleman or a female on my right, they're able to sell, as compared to us in offices.
So this actually adds to what you're saying. Before, entrepreneurship used to be 75% male dominated. Actually, as high as 74%. It was 74% male dominated. As you can see, back in 2017, 53%. And the entrepreneurs I'm counting here, Vernon, are people who employ one or more. So not people who operate by themselves, but people who employ one or more. So that's the important part that we're going to try and look at here. 53.16% of entrepreneurs back in 2017 were men above 35. As you can see, by 2021, that number is now down to 44.16%. So you can see that there has been a decline in the percentage of men because they've grown at a slower rate. Male entrepreneurs, in terms of the ones who are younger, they've risen from 20 male entrepreneurs, young male entrepreneurs have risen from 20.74% all the way as in 2020 to 2021 to 27.64%. So, and you also are seeing here that in terms of women above 35, that number stayed relatively flat. It's just gone down a bit from 16.9% to 15.6%, while you've seen that women below 35 entrepreneurs have risen from 9.19% of entrepreneurs to 12.54%. So at least it tells you where the breakdowns are coming from in terms of entrepreneurship. Now, women before were making up about 26% of entrepreneurs, while now they're making up about 28%. So the number has only gone up by about 3%. In terms of their composition, it is still mainly men. Now, we haven't put the self-employed numbers here, and obviously we'll share
Mhm.
that at another time. But right now, at least it gives you the rise of those who are business owners who are able to employ the job creators of Zambia. This is your engine, by the way, of job creation. These people here, they're the ones who are going out, seeing problems in society, deciding that something has to be done about it, and then hiring people to help them build businesses on that. These are your people who are employers, okay, registered employers, and able to get started. So this is quite a good way of looking at it. Now, in terms of women participation in the corporate world obviously is growing slower. Remember that labor formalization is now down to just 10% of the adult population. Only about 10% of the adult population, while obviously entrepreneurship is only starting to sneak up slowly in terms of its participation. Now, Vernon, I also wanted to then ask the question. A lot of people are struggling with this decision in their finances of transitioning out of employment and into entrepreneurship. It is a tricky situation. Some said I went into employment just to get experience, but my aspiration is to be an entrepreneur. So the questions I want to ask most people is this: whether you should be an entrepreneur or a business owner is going to be dependent on one. Now, whatever reason you go in there for at the beginning, that's up to you. Okay.
Mhm.
You are free to have whatever reason because initial reasons often change. We evolve as people because we've never actually run the business. But when people are now running the business, there are two reasons they love being entrepreneurs. One, they love that they really have a deep interest for the problem they're solving. Eventually, they went in there, yes, to make money, but they eventually grow an interest for this problem that they're solving. Okay, whatever the need or the product is. And the second reason is they actually love the team they work with, or they love the environment that they've built, or the kind of the team they've managed to put together. So these two things are going to determine you. Now, if the key, the critical, Vernon, the most critical, the critical characteristic of being an entrepreneur is resilience, because you will go through things. Okay. So this is the question you have to ask yourself when you're trying to say, should I make this jump? Should I not? How will it affect my finances? Everything. You got to make the numbers do good, especially if you're, let's say, 35, because it appears in Zambia the majority of entrepreneurs are still above 35. Okay. And by 35, you've got a family, you've probably got kids. So just to come back here, in fact, just to give you just to give you this outlook, if you look at this picture, Vernon, and you put these two together, you are seeing that about 60% of your entrepreneurial base is above 35. Okay, before it used to be much bigger than that. We were looking at about 69, we were looking at 70%. So about 60 to 70% of entrepreneurs become so above 35 years old. By 35, you've got family responsibilities, and it's not that easy to go into entrepreneurship. So we're looking at that transition that people make from employment to entrepreneurship, which is what a lot of people do aspire to do. They say, let me get started by working, but eventually let me start my own thing. So, how are you feeling about making that transition and whether it makes sense for you? The questions are: do you have an interest in it? The second question I would ask you more than anything is: do you have resilience? Are you able to look at the worst case scenario? Imagine, Vernon, you've left your job and you're going to go about 2, 3 years with no income, okay, or basically no income. Can you stomach that? Does that terrify you to the point where you cannot move an inch, or is that something that you can say, I can live with this, and maybe I can just dust myself off and get back to the employment world if I bomb out of this whole entrepreneurship thing? If you can manage that, if that sight doesn't terrify you to the bones of your body, then you can give it a try. Because look, I know people will say, don't do this, don't do that, don't do this. At the end of the day, I'll tell you this: when you're 85 and you're looking back at your life, it's only you who lives with your decisions. Nobody, including me, who's talking about this right now. I had to ask myself, I'm going to live with these decisions, not what everyone else is thinking about. And remember, Vernon, if we go through the top 5 deathbed confessions, okay, the top five, it's a death, what do we call deathbed regrets? I don't know if you remember, we talked about that.
Mhm. Mhm.
Yes, if we look at the top 5 deathbed regrets, or the top 5 deathbed confessions. And this was a nurse who had actually written down this book, and here they are. Here are the top 5 ones. Number 5, I wish I stayed in contact with my friends. Number 4, I wish I had the courage. I wish I had the courage to. Yeah, sorry, I just want to get the fourth one. I wish. So the fourth is I wish I stayed. I wish. Sorry, number 5. I wish I had let myself be happier. Okay, so most people are worried that they gave into duty or whatever and never allowed themselves to be happier. So they wish they actually tried to do things that would make them happy. And entrepreneurship people do that for happiness. I'm not saying it'll make you happy. I'm just saying they do it for happiness because it's something they believe in or something they see themselves, or they want the freedom. So many people do it sometimes because they just want freedom and they feel that freedom will make them happier. I wish I stayed in contact with my friends. Number 4, I wish I had the courage to express my feelings. Many people feel trapped, Vernon, where they say, you know what, I want to go into this, but what will people say? People will judge me. I have this lovely job, which everyone wants. I'm miserable as ever. Okay. And I know people will say, just stomach it. It doesn't matter. Live with it. But people, misery is a very dangerous thing to live with. You first of all, you start spreading it around. You start making everyone else miserable because of your misery. Okay. And then you start to transition it to people. So there are issues that are happening here. So people should question. But these are, like I said, these are the questions people started to talk about when they were on their last days. This was in a hospice center, and they were talking about this. The second one was, I wish I didn't work so hard, and I wish I spent more time with family. And the first one, which is more important, I wish I had the courage to live a true life to myself and not what others expected of me. Number one reason I've seen many people terrified to make this leap is they will feel judged, especially if they fail. Okay? They are so petrified of judgment, which is what most of us are. And by the way, that's normal. It is normal to be scared of judgment. Okay? That's the number one thing that hinders a lot of people from trying to start the businesses they want. So if you think about it, then how do you make this transition? So I'm going to talk about 2 things. I'm going to share 2 things, Vernon. I'm going to share my story. Okay? My story was that when I started work, I started work as a stock market analyst. I was a junior researcher at the stock market, and I started to work as a stock market analyst, and I worked my way there. My best friend comes into Zambia. He starts working. He starts working as well. Now he was working for about 3 months before me. We were earning exactly the same. We're the same age. We've been friends since we were 13 years old. Now, 3 years later, I moved up. I moved up the ranks a bit. He moved up the ranks a bit. I got frustrated, and I decided, you know what? I've always wanted to start a talent agency. Okay, I loved entertainment, so I thought, okay, I know business, I know finance. I'm gonna go and try and start a talent agency to try and help people with the business side of things. Now, big mistake, Vernon. I went into a field where I had no name, I had no name recognition, I had no knowledge of the industry, and I had no knowledge of people. So I was in the dark, in the cold, trying to shoot bullets in the air. And I made it to a certain extent, but I struggled a lot in that one, and it actually derailed my life a lot. My friend stuck with it. He did say, look, he was frustrated a bit with work, but he continued to get proficient. And in that time where I stepped out, he was now elevating up. He went up about 3 slots in the company he was in. Now I went out. I went back into the work world back in 2016 through a few connections back into the capital markets, back into this industry, and I started to grow again and again. Okay, this time I grew again. Growing with a bit of frustration, I hopped between 2 or 3 companies because I was looking for something. I was looking to I was looking to build something. I was hungry for that entrepreneurship drive. Then again, I around 2019, I stepped away from the capital markets industry to pursue a business idea, something I felt strong and passionate about, which had nothing to do with capital markets. Big mistake again. I went into an area, no social networks, no knowledge, no prior skills. And as a result, I ended up falling again. And that one was traumatic for me. Then the pandemic came. I made a decision, Vernon, that I will build a business, but I will build a business in an area I have experience in. And this is the conversation I want many people to try and think of. If you've been working, you've accumulated career capital, because my friend throughout all of that rose to being one of the highest senior managers in that institution, was even transferred to another country and was able to rise through there and currently has the pick of his life because he managed to get very good in a specific field. He first focused on proficiency, which has given him the career of the freedom he wants, while I, on the other hand, had to kind of, it has retarded my process a little bit. So the growth I'd like to say to as many people is focus on areas where you already have some sort of strength. Okay, focus on areas where you already have some experience because you'll have knowledge enough to get started. So I'm going to read a quick article, Vernon, from a group called NFX, and they're a venture capital outfit. And they talked about four components of what they call founder market fit. Are you good to start a company in this industry? And the four components they singled out, Vernon, were you must have an obsession with the product. In other words, you must be obviously obsessed. You must have a founder story. You must have a personal experience that makes this almost emotional for you. You must have the personality, the standard personality. Are people in that industry hyper analytic? Are they very expressive? Are you the standard personality, meaning you probably network well in that industry? And finally, do you have experience? People don't like to look at this, but you should have some experience. So, Vernon, I would say here, in terms of experience that people should have, I'm going to read very quickly what they say here in terms of experience. They said, as mentioned earlier, experience is often overrated when it comes to founder market fit. In other words, when it comes to starting a business, experience is often overrated. If you look very closely, you'll understand that a lot of nuances is required to properly evaluate how experience influences a person's fit to starting a business. First, too much experience is not a good thing. Okay, certainly we do not look for founders who have enough industry experience that they understand the market. They do want that because you need an understanding of the market, but not so much experience that they don't have any disruption left in them. Because usually when you have got too much experience in an industry, you've now succumbed to the culture of that industry, and therefore you
Yes.
struggle to disrupt it. So you
Mm.
don't want too much experience that you struggle to change anything, but you don't want to be so unexperienced that you don't understand the ins and outs of the market. So there's a balance here. At some point, if you stay in a sector too long, you will get the curse of too much knowledge, and you will stop being able to see fresh and new ways of doing things. The angle of innovation becomes harder. So ignorance is an opportunity for 1 out of every 50. Knowledge is an opportunity for 1 out of every 5. Too much knowledge is a blocker to innovation. That's an actual saying that was put out there.
Yeah.
So we know from our own experiences what they were saying, that the typical way to invest in a B2B business is to find somebody who did it before or doing it again in the same space. Experience is more important, especially in the business to business sector. Okay, so if you're in the business to business sector, not business to consumer sector, business to business where you're serving institutions, you might want to have a little bit of experience because that is a very sensitive place where CVs are needed, recommendations are needed, all sorts. But in the B2C area, you may not need as much experience. So here's what they say in terms of this. This is what their recommendations were. For the average B2C entrepreneur, you need about 3 years of experience. And for the average B2B entrepreneur, you need 5 years of experience. If you're running a business to business company, have been in it for at least 5 years and have been in it for at least 3 years if you're running a B2C company. So you want to have just enough experience to understand the supply chain. Who are the competitors? What are the problems of the industry? Who are your regulators? But not too much experience that you are stuck. Okay, so experience is quite important. About 3 to 5 years work experience is often good, some sort of apprenticeship. And Vernon, I will then share with you however, the risks of people who I've been working in this field, and then I've just decided to switch to a field that is absolutely different. Okay, and the risks you face. So I always tell people, and this is why I gave you my story, go into a field where you have career capital, okay?
Yeah.
Where you know who, where you know how, and you know why. If you know who, know why, know how. Okay, sorry, if you know who, know why, know how of all those things in your industry, it's actually a good idea. So I'm going to quickly share this 1 to 2 minute video that'll actually talk about.
as sort of a metaphor helps you understand those type of decisions. So I tell a story in my book about a marketing executive, example here, except for instead of a beekeeper, she quit and did a 4-month or 4-week actually yoga instruction course to become a yoga instructor in the New York area. And by the end of that first year, she was on track for making something like $15,000, which supposedly in the New York area doesn't go as far as you might like it to be. Career capital helps you understand what was flawed about that move. She had a huge amount of capital in marketing. She had 0 capital in yoga. So by jumping to a 4-week instructional course, she gave herself just a little bit of career capital, not very much at all. So she shouldn't expect to be able to gain much great traits in her life right away because she doesn't have much capital there. So when you think about things like that, it helps temper the impulse to try to start over or do something from scratch. Because if you believe that it's building up capital and leveraging it is what makes you love your work, not the matching problem, I'm more meant for this job than that, you'll be much less likely to jump into something completely new because you're actually retarding your progress at having more sort of control and leverage. So I think this metaphor of career capital helps you assess whether a change you're making is I'm bringing my capital with me, but I'm bringing it into a new market within my field that it's going to have some impact versus I'm leaving my capital on the table and doing something completely new. It allows you to have those nuances that without the metaphor can get sort of confused. If you're building capital in technology, to expose yourself to lots of things is actually a great way to find potential opportunities, asymmetries in the market, some place where you can really make a move like Steve Jobs did. But to be at Google and to also be exploring theater and to also be exploring filmmaking and also be exploring beekeeping, well, you're crossing strong career capital division lines. They're completely unrelated. And then you run the risk of slowing down your acquisition of capital in any particular. So I always understand the sort of hybrid approach that you have a general field in which you're building capital. By doing exposure within there, you're actually gaining more knowledge, more expertise can actually help you build and apply it. So I think that's where that advice is valuable. I think it's dangerous when people apply it too broadly and are covering too many things that are way too disparate.
So quickly, just to wind that up, I don't know if Vernon is here. So to wind it up, what he was just trying to say is you don't want to cross over, Vernon, away from what you know, what you're capable of knowing. Because you've got value. You've actually built value. And a lot of people who just say, okay, I've been an accountant all my life. Now I'm just going to be a chef. Like actually there being a chef. Like, you get that shock, that's where the problem hits you. You get this huge shock because you switched career capital lines too strong. And therefore you haven't built up enough name recognition, brand recognition, knowledge of the industry and friends to help you through it. You haven't built enough of it. And therefore, you really struggle through the early stages and it will hurt your career progress. So possibly if you're going to make a transition like that, perhaps work with somebody partner with somebody who has got that career experience. So if you're going to start a restaurant together, say, I've been an accountant my whole life, so maybe I'll do the business side of it, but why don't you do the actual cooking side of it and let's work together. So if you're going to go into a field which is diverse from yours, then you need a partner. If you have got that experience, then kind of diversify there. And quickly, Vernon, finally, the thought of the day, the quote of the day. I know that we've run out of it, but Peter Drucker did say this. Innovation is the specific instrument of entrepreneurship. The act that endows resources with the new capacity to create wealth. So remember that just because you want to try and go into entrepreneurship, it's really about solving a problem in a different way, not a different product, but in a different way, or delivering the solution in a different way, or serving people in a different way. But remember, Vernon, I have been talking about this because the greatest wealth is built by our entrepreneurial base who create jobs and they create profits, which then acts as capital for society. That, Vernon, is our roundup for the day. Have a wonderful day, my brother.
Thank you. You have yourself a good one.
Cheers.